Hello and welcome to Bottom Line. Good evening. India is staring at a perfect storm. The rupee is plunging to its weakest level in years, while crude oil has surged close to $120 a barrel. This double whammy is hitting the economy where it hurts most: imports, inflation, and your daily expenses. Today, I'm going to break down exactly what is happening to us, why it's happening, and what it means to you and rest of the country. Right now, as of April 30, 2026 evening, the US dollar is trading at 90 rupees 80 paisa to 95.30 against Indian rupee, an all-time low zone for the rupee. Brent crude, the global benchmark India uses, is hovering around $111 to $119 per barrel, with intraday spikes touching almost $120 yesterday. Some physical cargoes have been crossed even 120 mark. Now let's look at how fast both have moved in the just past few weeks. For the rupee, early April 1 to 10, it was around 92.30 to 93.5 rupees. Mid-April, up from 13 to 20, it was 93.50 to 94.50. Late April, April 22 to 30, steady climb to 94.80 to 95.30. That's almost 2 to 25% drop in 3 weeks, with almost half of it in the last 7-8 days. After a massive jump in March following the West Asia conflict, April has seen yet another 7 to 8% rise in the final week alone. Prices are now at multi-year high, more than 50% higher than the $60.72 range we saw in January, February this year. So, why is this double surge happening? The root cause is the same for both: escalating geopolitical tensions in West Asia, particularly the US-Iran conflict that's exploded in late February 2026. What are the triggers for this? Number one, military action has effectively disrupted the Strait of Hormuz, the narrow choke point that carries nearly 20% of the world's oil supply. Number two, major producers like Iran, Saudi Arabia, and the UAE have sharply cut output due to shipping risk and infrastructure threats. This has obviously created the biggest oil supply shock in decades, pushing a huge geopolitical risk premium into prices. At the same time, the strong global US dollar, driven by safe haven flows and higher US yield, plus heavy foreign investment outflows from Indian markets and India's widening trade deficit, have hammered the rupee badly. Higher oil imports mean India needs far more dollars, feeding the currency weaknesses in a vicious cycle. Now, what does this double whammy actually mean for India? India imports 85 to 90% of crude oil, as everybody knows. When oil costs more in dollars and the rupee buys fewer dollars, the import bill skyrockets. What are the consequences? Petrol and diesel prices are set to rise soon, sharply at the pump from 20 rupees to 25 rupees per litre, it is expected. Higher transport and freight costs will push up prices of food, vegetables, groceries, and almost everything we buy. Number four, inflation, already a big concern, could climb further from 4 to 5 to 6%. The government will have to increase subsidies to shield consumers, widening the fiscal deficit, which is already a matter of concern. Overall economic growth could slow down. On the flip side, exporters may get some breathing room from the weaker rupee. But for the common citizen and most businesses, the pain is immediate and widespread. Obviously, the Reserve Bank of India is closely monitoring the situation and has tools ready, what they claim, from forex market intervention to possible trade adjustments. The government is also in touch with global suppliers for any emergency crude purchases. But with the conflict showing no immediate signs of easing, the pressure could last for weeks or even months. That's all for today's bottom line. Whether government will take immediate action or wait for something else, the elections are over and government is free to take action, but ultimately consumers have to watch whether they will suffer or not. Expensing oil and falling rupee, a textbook double whammies that's testing India's economic resilience. We will keep tracking every development. I'll come back to you. Meanwhile, thank you very much for watching The Bottom Line.